I want to welcome everybody. The sun came out. We'll see how long that sticks. We have a great session lined up, and I want to thank John Babitt for organizing this session and for being such an important partner. EY is a huge partner of what LSI is doing here, and so I want to thank him for that and pulling together this terrific group of panelists. I'm going to just turn it right over to John. I think everybody knows him, but I'll let him give a short bio on himself. We'll get at it. We have this unpanel philosophy that we're adopting, which is that we'll get into it quick and we'll challenge each other. So over to you, John. Thank you.
Yeah, no, thank you, Scott, and thank you to the LSI conference. It's always great to be here, and it's even better when the sun is out. When it was raining, it just reminded me of all those miserable JP Morgan conferences. So thanks for bringing SoCal to the house. John Babitt with EY, going to be hosting this M&A panel, and I think it's really appropriate that we had the strategics spill the tea, we had the strategics tell their story, and now we're going to get into where it all kind of comes together with MedTech M&A and a real diverse perspective. You'll hear we're going to have really opinions from all sides of the equation, and we'll get things started. We'll let everyone introduce themselves, give you a little bit of their background, and then we'll go through a handful of slides to just kind of frame out what the current state of MedTech is from an M&A perspective, and then we'll get into the detailed Q&A. So with that, Bennet, do you want to kick things off?
Of course. Can you guys hear me?
No. Just keep talking.
Well, it's great to see everybody here today. Bennet Blau, Managing Director with Goldman Sachs. I help oversee, I think I've met many of you in this room. I help oversee our medical devices franchise in the investment banking division. And so we work with companies large and small, from some of the largest public companies, obviously within the MedTech universe, to many of the emerging and digital health names, which are really creating some of the most exciting technologies out there in impacting patients, impacting clinical outcomes. So pleasure to be with all these panelists today. John, thank you for hosting us.
Great. Matt?
Matt Tomkin, VP of Corporate Development for Teleflex. Been with Teleflex since 2015. Started my career in public accounting and was looking for a little bit more excitement in my life, so I made my way to M&A. And for those not familiar, Teleflex is a global publicly traded medical device company. We've got almost 14,000 employees, just under $3 billion in revenue, and a diverse set of product portfolios spanning from interventional cardiology to interventional urology, surgical, anesthesia, vascular access, emergency medicine, and an OEM division as well. And we've been very active from an M&A standpoint. We've done over 80 deals since 2011, including transaction values over $5 billion. So pleasure to be here, and look forward to the discussion.
No, look forward to it, Matt. And Greg?
Yeah, thanks, John, and thanks for organizing this. Greg Banker, I'm with Vensana Capital. We're a MedTech-focused VC firm. We have a team of 6 spread between Minneapolis, the Bay Area, and the DC. Currently investing out of our second fund, which is a $325 million fund, investing in MedTech broadly defined as anything outside of drugs. So trying to build a concentrated portfolio over the next few years of 12 to 14 companies, which works out to be average kind of check size of 20 to 30 million per company over the life of an investment, but it can start as small as 10. Relatively stage agnostic, kind of a natural entry point for us is kind of post first in human data. So we'll fund a pivotal study, we'll fund commercialization, but we've gotten earlier on occasion as well.
Great, thanks, Greg. And John?
Okay, John Kilcoyne, the President and CEO of JenaValve, located in Irvine. We're currently in development of a aortic valve for both aortic regurgitation as well as aortic stenosis. We have an approval in Europe for a dual indication. We're currently just completed enrollment in our clinical trial in the United States. We look to file our PMA at the end of this calendar year with an approval sometime in the second half of 2024. About 170 folks that work at JenaValve currently. And over the course of my career, I've had the opportunity to work in multiple different disciplines. As a CEO, this is the 5th opportunity that I've had to run a company. I've both worked in private as well as public PMA, 510K, taking a company called Microsendovascular public on the NASDAQ exchange, which we sold to J&J. And Peter Stebbins is here somewhere in the audience, at least he was, and I thank you again, Peter, for that acquisition. It was a life-changing event for me, as well as my family, but thank you for that. But it's a pleasure to be here, and look forward to sharing my thoughts with all of you.
Great. Thanks, John. I just realized I need to get the clicker to advance the handful of slides that we had. So just started out, we thought we'd tee things up and get things started. Hopefully they can bring those up. And if not, we'll just go into the questions. Of course, we got to start with the disclaimer and got the panel. But really, as we sit here kind of coming out of 2022 and going into 2023, it's an interesting time of reflection. That was kind of the title of the panel that we proposed, which is, you know, what comes next? We've kind of put COVID in the rearview mirror, so to speak, a little bit. There's a lot of normalization of the med tech industry. And so what does come next? And, you know, just to give a flavor for this, med tech returned to a growth rate of about 6% last year. And, you know, as we kind of exited the 2022, roughly $500 billion in revenue for the first time. So the industry emerged out of COVID, some would say, stronger and more robust than ever, with good prospects going into 2023. But what we saw last year in these middle columns is that, you know, from stock price to total financing to VC capital, all of it was on the decline. So, you know, begging the question, what comes next? And M&A activity in the second half of 22 was pretty sparse. We did have the one big J&J deal, but outside of that, not a lot of activity. And so as we came into 23, you know, a handful of deals, looking, you know, some green shoots. And so, you know, I think it's an appropriate time to ask, you know, really what does come next? And so, you know, on the back of that, what we also have are some real headwinds within the industry. And we saw a lot of the hospital staffing shortages really remedy themselves, but, you know, we're still hearing some issues in the ecosystem. Exchange rates have impacted earnings for a lot of the large OEMs, and that's a, you know, headwind on the revenue. And, you know, on top of that, now we have some financial distress with some of the recent bank failures. How does that impact things? All that, and when you look down the P&L, real inflationary pressures for large OEMs. And so for the first time in a while, you've heard about cost-cutting measures and, you know, things like supply chain and cost-cutting rising to the list of priorities for large OEMs. And then you have a lot of these local issues that all of a sudden kind of crept into the calculus of the large OEMs as well, like, you know, China volume-based procurement and things like the Italian clawback. And no, that's not just a bad drink in Rome. But looking forward, you know, when, you know, COVID hit, it was actually kind of the best of times for med tech. And, you know, this is a graph that you can see kind of going across the x-axis that looks at high growth med tech revenue companies and what multiples those are trading at. And you can see in the era of COVID, we actually hit a peak of about 16 times forward revenue. You know, that declined over the last year, and now we're sitting at a rate that's about 7.3 times forward revenue. Most noticeably, at the bottom of the graph, you can see the IPOs, and you can see in 2022, last year, we didn't have any. And so now we have a couple that I think have gotten out this year, and some in registration, but still not a real viable exit. And that's one of the things we'll talk about. How does that feed into M&A as well? Just a couple metrics that will feed into the ecosystem here. If you look on the top part of this graph, it shows you that the number of deals was down last year. But if you look at the bottom of this graph, it shows you that actually the takeout premiums were up. And I think, you know, one of the things that this indicates is that good deals are still getting done, and they're getting done at a premium to where the market is. And so with that as the backdrop, I think what we'll do is turn to the panel. And, you know, we heard a lot from strategics already. And so, Greg, maybe starting with the VC perspective, you know, boiling it all down to the M&A environment. I mean, we got some headwinds, we have some tailwinds. But what does this all mean for M&A as you sit here and look at your portfolio going into 2023?
Yeah, happy to comment. Thanks, John. So, you know, I'll take maybe the tailwinds first. I think I have a little bit more of an optimistic view of the current ecosystem. So, while it's gotten harder, I think, in this current year to sort of raise new venture funding, if you kind of look at the 2020, 2021, and 2022 vintages, there were a lot of new funds raised. And so if you just think about the dry powder and capital that exists with firms that do invest in medtech, I think it's pretty healthy. I think you're talking on the order of, several billion dollars available. On the other side, as we think about kind of the strategic landscape, if you think about the number of strategic companies that have a market cap of $20 billion plus and have healthy cash balances and debt available, that list is probably 20 companies long, if not more, and that's probably 3 to 4 times what it was in kind of the 2009 era. So I actually think, from a capital and exit environment, I think we're actually in a better spot than we were probably in 2009. As we think about headwinds, I think one of the challenges, and you alluded to this, John, is, many of us are funding, developing, and launching novel technologies into hospital systems, and many of our hospital systems in this country, due to COVID, are in the red, right? And so we're trying to change behavior, drive adoption of new technologies when a lot of these groups are just trying to keep the lights on, doing what they do normally. And so I think it creates, difficulty on sales cycles, difficulty on sort of launching new technologies, and it's a different environment that we've had to commercialize in now than we have in the past. I think the biggest question, for us at the VC side, and as we talk with our portfolio companies, is just what's the realistic time to exit, right? As we talk to our advisors and bankers and strategics, the perfect exit candidate is something that's not dilutive, right? It's commercial stage. And so if you think about the amount of capital and time required to take a company from development through clinical trials, through regulatory, through established reimbursement, and then building up a sales force, it's a long time, right? And obviously some inefficiencies there when you're sort of funding a sales force of 20 to 50 people when your strategic acquirer may have a sales force of 300 to 400. And so I think as an industry, it's something we got to continue to work on, is how do we make, our companies and our ecosystem have earlier exits in an environment that's really, dilution sensitive from a P&L perspective, just because I think the longer that we have to fund companies to exit, the more and more pressure it puts on the math, and candidly, the more pressure it puts on for sort of earlier stage investment.
Oh, that's really insightful. And maybe to just pull that thread a little bit, John, you guys did a big capital raise over this last year. M&A window and IPO window were relatively shut. So what was it like going through that process, and do you think we'll see any changes in that dynamic here in 2023?
Yeah, I think thank you. The company did complete a $100 million financing in September of last year, which was a little bit contrarian to most other companies' ability to raise money, and I think that stems from a number of different things. One, it was a long process. It was well over a year-long process, and quite honestly, our strategy, changed a little bit as we went through. As the IPO window at the beginning had some semblance of being opened, so the cash that we had raised might get us to a public offering. As we went further into the raise, it clearly became evident that the IPO window was probably not going to be open, and more than likely it was going to be closed. So the use of proceeds no longer became a bridge to a potential IPO. The use of proceeds became a runway to market reopening, which, not knowing where that market is going to reopen or when the market's going to reopen, the amount of cash required to get us, through that runway doubled. In our expectation, and our fundraise went from about a $50 million initial target to a $100 million target. The good news for us is that we have an outstanding product that's doing extremely well in Europe. We have a CE mark, both for AR and AS in Europe. The adoption has been good. The clinical outcomes have been good. The feedback from our clinicians has been really good. So we have a tailwind with positive clinical data, and as a medical device company, data is your capital, along with IP, but data and capital is extremely important, and we also have a good IP portfolio. But with that data, and combined with the ability to learn as we went along in the US as to how to enroll, how to get patients into the trial and treated, our enrollment accelerated towards the the spring of last year, enabled us to complete enrollment. So we had really nice stories and milestones to express as to why that we have forward-moving progress, that the opportunity at JenaValve is significant. We just needed a little more runway. With that, we're also blessed with a very strong syndicate existing at the time, the existing syndicate as we went into the fundraise, led by Bain Capital. Bain was our Series B lead, and actually Bain stepped up and led our Series C, which provided us a great foundation. Bain is a household name It is the good housekeeping seal of approval, and they were very supportive in the Series C, which allowed us, significant throw weight going into the market when you combine that with great clinical data and IP, and we were able to close on a financing. So the tailwind for us coming out of 22 was very positive. Now the headwind going into 2023 is just as we've described here, is the public markets, the rising interest rates, the political uncertainty that plays into the mix. And so the good news, again, optimist, that we have cash runway to the end of 2024, and I do believe the market will open up at some point during that period and give us a potential window to jump through.
Yeah. And Matt, maybe bring in kind of the large OEM, point of view with, some the headwinds, the tailwinds, and does that change your strategy? Does that present more opportunity for you? Do you get more aggressive, or do you really kind of inward focus and more on the cost cutting or some of the other things that we've heard other large OEMs mention?
Yeah, I think for companies like Teleflex that have a strong balance sheet, we're going to continue to prioritize M&A. That's how we've grown historically. That's how we're going to continue to grow. And while it's you pointed out that public company valuations have certainly come down. If you look at the more attractive publicly traded entities, they're still trading at high multiples. So it's not like everything has suddenly all of a sudden just become affordable. And then you've got this high interest rate environment, which is obviously here to stay at least for some time. And it's, you've got this dynamic between high rates and still high transaction multiples where, that dynamic seemingly can't coexist if we're going to get back to kind of normal levels of M&A activity. So, we're going to continue to do what we've done. Every company like us is focusing on cost cutting, and, those are announced in our investor presentations. But for the most part, we're focused on how are we going to grow going forward, and it's going to be through M&A.
Yeah. And Bennet, maybe round us out. You obviously have a lot of clients that are active in the M&A space. Are they thinking more opportunistically about as they're kind of going into 2023, or are they battening down the hatches?
Yeah, I'll make a couple of observations. Thanks, John. I think, first and foremost, if you think about medtech M&A, over the course of the last 3 years, really we've had one giant deal in each of the last three years. We've had the privilege over the course of last year, obviously, in selling Abiomed to J&J. The year prior to that, you saw a deal where Hillrom got sold to Baxter, and the year prior to that, we had sold a company called Varian Medical Systems Radiation Oncology business to Siemens Healthineers. So if you think about the largest kind of types of deals that we see within medtech M&A, these are not deals that happen every day. These are not deals that kind of we see every quarter. They kind of, at least over the last several years, we've seen them on kind of an annual basis. And so I think from that perspective, when we speak to clients about big deals, transformative deals, that level of activity remains, I actually think, quite robust. As you start to scale down into mid-cap, smaller cap companies, I'd say the level of screening for public companies, whether it's relative to 52-week highs, whether it's relative to various VWAPs, the intensity of activity in terms of that type of screening has certainly accelerated meaningfully. But the interesting thing is, if you think about it, at least from a banker perspective, from a board perspective, whether a private company board or a public company board, of course there's a affinity to past trading, but yet at the same time, the actual metrics that we care most about are intrinsic measures of valuation, things like cash flow and discount cash flow analysis and so forth. And what I'd say is, even though those forecasts have come down somewhat in many cases, the level of their decline has been much more modest relative to the decline in public market valuations. And so I guess what I'd leave this group with in terms of headwinds and tailwinds and opportunity is M&A dialogue and activity, certainly in terms of what we're seeing here at Goldman Sachs, remains quite robust, but it's also incredibly idiosyncratic. It's more idiosyncratic than we've probably seen in the last decade in terms of how large companies are evaluating the ecosystem to see how and where they want to play. There is a general willingness to deploy capital. Again, it needs to be in the right strategic areas, but by no means do I think the volatility has kind of stamped, that sense of opportunity from a M&A perspective.
Yeah, and maybe just a follow-up question, because it's been interesting. We've seen a handful of public companies now get taken out at those historical 52-week highs, and now all of a sudden, we're coming into April and May. Those 52-week highs are getting further and further in the rearview mirror. I mean, will we, perhaps see more of that type of activity that now that it gets a little bit further in the distant?
I certainly think that's the expectation, John. I think it's kind of ironic because again, the 52-week high is nothing more than a historical reference as opposed to a fundamental assessment of the value of companies. And so, but I do think that as a reference point, that has been quite important in terms of many of the discussions that we've had. And so whether that means that those that sellers that are willing to transact, perhaps there's a resetting of that expectation. I think we've started to see some resetting of that more recently. I also think it's highly, highly dependent on the balance sheet strength of the particular company. And I think what you're seeing today in the M&A world that we see day to day is it is more important than ever for medtech companies to really control their own destiny in terms of having a plan without a predetermined exit by X date.
Yeah.
I realize that's easier said as a banker than actually done. But I think that the importance of having that credible standalone plan is greater in today's market with this volatility than, again, we've seen in many years. And there's a saying in M&A which I think now resonates more in this market than ever before, which is, companies really get bought, not sold. And so being able to chart that own standalone plan and set yourself up for an exit if there's an approach, but again, having a lot of conviction in that standalone path, we think is more important than ever.
Yeah, no, that's going to be interesting to watch unfold here over the next 6 to 9 months. And speaking of which, when we put this panel together, one of the topics not on the list was some of the financial dislocation that's occurred recently with some of the bank failures. And not that has maybe a direct impact on M&A, but it would be curious, maybe Greg, you have a perspective on this, from a VC lens, does all this uncertainty within the financial system and just what's been created, does that create any opportunities from an M&A perspective, or how are you guys viewing it from a VC lens?
Yeah, it's a great question, John. So I think, I think if nothing else, I think equity financing becomes more important in the coming environment, just because venture debt has been a very significant way to boost runway. It's less dilutive to founders and an existing syndicate, and so I think to the extent that that's less available, I think it puts more pressure on companies to have really strong syndicates, to have firms like ours that are reserving and making sure that you can go long if you need to. To your point, John, I do think it does create some M&A opportunities potentially as well, because you are going to have some really high quality companies that potentially can't get a financing done, and so they do look to sell earlier, and maybe they don't maximize value as much as they could have. But so I think it can work both ways. Yeah, no, I think it'll be interesting to see which way it cuts, but I think net is going to increase activity for sure. And Matt, one of the things we talked about was some of the cost cutting effort, but one of the things that we hear a lot is around capital allocation, and so it is an M&A panel. Divestitures and spins are certainly quite the rage across corporate medtech these days. How are you guys at Teleflex thinking about that as one of the arrows in your quiver that you can use to maybe solve for some of the pressures?
Yeah, I mean, the way that we think about it is we're still, given our size, primarily focused on acquiring businesses. So we don't feel like we're too large where we have to divest something or spin something off to unlock some value. But we do occasionally look at our portfolio for pieces that are non-core, slower growth, lower margin, maybe better in the hands of somebody else with a little bit more focus, more investment. We demonstrated that. We sold our respiratory business to Medline in 2021. Yeah. But when you really look at some of these pieces of the portfolio, some of them generate a lot of good cash flow because you don't have to invest in them that much. Yeah. And so that cash flow helps support some of the high growth franchises. So I think as a whole, we'll continue to look at portfolio rationalization and consider it, but our primary focus is on acquiring companies.
Yeah. No, I know sometimes it's interesting when companies go public with the financials of the parts of the organization that they're divesting, and the street is caught off guard. But wow, I knew it wasn't growing, but it was actually really profitable. And so it's always one thing to pay attention to before you kind of head out with that, for sure. John, would be curious to get your input because you guys did a large capital raise, the public debt markets, and was that something that you guys looked at as part of your evaluation when you're evaluating capital sources? And is there still opportunity there for companies really to tap into that as a source of capital?
Yeah, I mean, look, we have a situation now where the exits are being compressed via strategics because the IPO market is not available. The strategics can sit back and wait, and they're very content to allow companies such as ourselves to minimize their risk and spend forward to put the company in a better position. So I think it's beholden on us as the operating group to look at all avenues of available cash, be it debt, be it licensing, or be it equity. I would agree that equity, there's continued benefit to an equity, but the debt side, there's a certain percentage of debt that you want to maintain and not exceed as it becomes an overhang for potential investors coming in or being, the exit. But I do think that is a viable option. I think we're also seeing that some of the debt lenders, particularly in our transaction, they're also interested in an equity component of their debt. So we looked at multiple different avenues to maximize the cash and maximize the runway. And I think we'll talk maybe a little bit later about a licensing arrangement that we made with a group in China. Yep. So yes, I do think there's opportunity. I think companies would be wise to not close any window to financing because we don't know where the back end of this IPO market will end.
And Bennet, we're hearing a lot about the spins. We're hearing that the credit market is improving. Is that going to be a viable option? Will private equity somehow return to the table here in 2023?
Yeah, look, I think if there's one tailwind that I would highlight heading into 23 and beyond, it is the amount of capital that financial sponsors, broadly defined, can continue to have available to deploy. And if you think about, obviously, the traditional LBO market, that has become exceptionally difficult from a debt financing perspective, just given where rates are, given where debt structures have moved and so forth. I think the reality of the matter is that there is a lot of equity capital. There are a lot of cash on balance sheets for sponsors to deploy. I think that has actually led to pretty creative financing structures where in some instances you actually see more equity put into deals than perhaps we've seen in the past because of that. I think one thing, folks need to remember is, these firms, for the most part, are incentivized in how they're structured to actually deploy the capital and to actually put that capital to work. So I certainly think if you, John, were to ask me, what is kind of one of the sources of capital that we would see more activity from in 2023, that'd be at the top of my list.
Yeah, it was interesting when we were at JP Morgan, I think the glass was half empty still. And what I'm hearing is that it's not maybe half full, but it's certainly getting close to there.
I think we've seen some improvements. I think it's far from being full, but I think the markets are moving, notwithstanding the last couple of weeks here that we've seen the right direction.
Yeah, and I think the other maybe telling sign is we haven't seen it in medtech, but we've seen private equity be more active now, doing larger deals. I think there were a couple $1 billion deals that were announced this last week, and so that gives, I think, hope that then cascades into medtech where appropriate. one area where, valuations took kind of a big hit was healthcare IT. And in the middle of that, John was out there raising $100 million, and Greg, you were writing a big check to a company called Clearly, which is in the AI space, healthcare technology. Maybe tell us, a little bit about, just that investment and the healthcare IT space and why that is a unique situation to be involved with.
Yeah, happy to, John. So as John mentioned, Clearly is a digital health company based in Denver, Colorado. They have AI software for coronary artery CT assessment where they basically have a proprietary algorithm that risk stratifies and phenotypes patient plaque burden and the risk for MI or myocardial infarction. And we led the Series B when the company had a developed product, and recently the company in the last year raised a $220 million round, and so quite a large round, obviously, for a company in our space, but it was led by a large syndicate, several large crossovers, and when we think about health tech in the context of Clearly, we don't view it too differently actually than our medical device investments. So this is a product that's regulated by the FDA. It's going to be prescribed by a physician. It's probably going to get a majority of its commercial traction from a fee-for-service paradigm, so it's going to need coding, coverage, and reimbursement. And they're targeting sort of two unique markets. One is, there's 10 million patients each year that have symptomatic chest pain that get some sort of non-invasive imaging. Many of those patients go on to get an unnecessary catheterization to find out that they don't really have severe disease. The flip side is there's a growing problem for patients that show up to as a heart attack for their first symptom. Depending on what data you look at, 70% of patients who have a heart attack, their first symptom is having a heart attack. And so there's kind of these two paths, right? The patients that are in the system today versus the patients who aren't even seeing a cardiologist. They're not on statins. They're not optimally medically managed. And our belief to unlocking both of those opportunities is really strong clinical evidence, right? Large, well-powered, randomized controlled studies with long-term follow-up. And so the goal of this capital raise was basically to pursue those kind of strategies in parallel in what probably represents one of the biggest TAMs in medicine, if we think about just prevalence of disease and clinical unmet need. And so the goal of the company, I think, is really to kind of have sufficient financing to sort of run those studies to fruition and not be in a spot where you sort of have to finance in the middle of a clinical trial, which is always tough. So.
Yeah, it was interesting. I think MedTech Drive announced their top 15 MedTech companies to keep an eye on, and literally half of them were AI companies. And so I'm sitting there wondering when Greg's going to start buying AI companies, but maybe give us a little bit of insight. Who is the likely acquirer for a company like that? Because our history has been, or just our experience is that it's the payers and then the providers and then MedTech third. But
yeah, no, it's a discussion we have internally every week. I think the case studies on digital health are still being written, right? Like there's been a ton of capital deployed in this area. I think a ton of clinical value proposition, but who acquires them, right, is still sort of an unknown. And so I think one of the things that we think about is just, we talk about kind of companies are, they're bought, they're not sold. And so, as we think about kind of a case like Clearly, I think if you have a really big TAM, you have really strong clinical evidence, and you believe you have sort of a decade-long runway to sort of penetrate into a prevalence pool that's really large, I think it justifies raising a sufficient amount of capital to do the market development work, to do the clinical study work, because candidly, I think those companies would struggle to get that same capital allocation within a strategic. Yeah. And so, I think many of these companies could be acquired, but I think, many of them will probably have sufficient markets to be independent companies and go the public market route once it reopens. So
yeah, no, it's certainly admirable. It'll be an interesting space to watch. It's a little bit of certainly the buzzword right now, and it'll be interesting to see how MedTech plays in that sector for sure. Go ahead.
I might just add to that as well. I think you noted, John, payers, which I think are kind of front and center based on the traditional models that we've seen in M&A. I think there's been a convergence as you think about large strategic acquirers across traditionally buckets that have been thought of as very different. So you think about, for example, CVS and how they've expanded their footprint over the course of the last number of years, more recently with the acquisition of a company called Signify, which we sold to them with home-based, value-based care type technologies and platforms. But you also think about big tech. You think about,
sure.
obviously, some of those, how those players are starting to move into healthcare in a big way, especially in the data world. And I think, traditionally those all would have been what I would call wild card bets in terms of the types of acquirers you'd expect. I think, in most instances, that's probably still the appropriate categorization of those types of companies, but it's becoming much more the focus, I think, in today's conversations. And then finally, I'd say there are a number of consumer companies as well that are actually looking very seriously at healthcare as a growth vector and thinking about how to expand their own footprint in digital health. And the one thing when we've kind of looked across these sectors, we've interviewed CEOs, CFOs, what is driving your strategy in M&A, especially if you're moving into healthcare technology? It really is around growth. And what I mean by that is, if you look at medtech specifically, this is true for some other sectors as well, but one of the most enduring patterns that we've seen, certainly in medtech for many, many years, is that the strongest single predictor of valuations, whether it's for private companies or for public companies, is expected growth. And that relationship actually remains true even in the current environment, where there's more focus on margin, but the importance of growth is still incredibly important. And so I think whether it's folks looking in at digital health, I think whether it's medtech looking at digital health, of course, the strategic logic needs to be there, but I think the financial logic is first and foremost, focused around growth and unit economics.
Yeah, it's interesting. We're not only getting more medtech companies in medtech with the spins with 3M and GE Healthcare, and the list goes on, but we're also getting new entrants, which certainly going to put a competitive spirit on the M&A process. So it's good to be a banker, I guess, these days.
I don't know about that.
It's interesting. One topic I wanted to canvass as we wrap up here is China. And in the fall, I ran a similar panel, and nobody on M&A, and nobody wanted to talk about China, but you guys were all relatively interested in it. So we'll chat a little bit, because I think from an M&A perspective, we saw Boston did a deal in December for a public company. There's been a lot of overtures about the volume-based procurement and what does that mean for long-term China strategy. And John, maybe start us out, because whenever we do like an M&A process of a emerging startup and they have a China partnership, it's kind of a man, we need to diligence that, okay? And so maybe tell us about, what you guys did and how you kind of thought strategically about, an important market like that.
So in a Series C, we did have a component of the round. The Chinese company, Peijia Medical, participated in. It was a licensing deal that we executed with Peijia along the lines of turning over every rock to extend runway with capital. We looked at the Chinese market, and the China market for aortic regurgitation particularly is as large as as AS. So it is extremely prevalent in China. The opportunity for penetration of that market is virginal. There's really nobody there, and there's a huge upside opportunity. But the reality of a company like JenaValve moving into the Chinese market by ourselves in the next 3 to 5 years, maybe even 7 to 10 years, it is rather challenging to contemplate with all that we have to do in the United States, all that we have to do in Europe, in the current embodiment that we're operating in. So we did have the opportunity to engage a company called, as I said, Peijia Medical. At the same time, AR is in its early stages of development therapy awareness around the globe. Peijia was very committed to therapy awareness development, and it provided us name brand recognition in the Asian continent, peer review, podium, et cetera. So it really extends the AR message to Asia, complementing our efforts in the United States and in Europe. At the same time, it was a non-dilutive component of the financing, which is, as the investors in the room, music to the investors' ears, that
Yep.
a large chunk of capital moving into the company in a non-dilutive fashion. There was an equity component with it as well.
Yeah.
So we doubled down with China. It was an opportunity for us to leverage, and it worked out quite well. They're great. They've been great partners. You never know what you're getting yourself into when you do any transaction, but we've been very pleased with the relationship with Peja.
Yeah, it'll be interesting to see. I mean, there's been a lot of papers written and a lot of research around is the juice worth the squeeze for some of the larger guys. We've seen some of the prices rebound after the VBP has went into place. So I think you'll see really a real mix of strategies there. M&A will be one of the levers, I think, continue to be pulled and be interesting for everyone. Well, with that, I think we are slightly over time, but we're going to put a pin in it. But thank you, the audience, and thank you to the panel for all your contributions. It's always great to be here. Thanks.